And the bigger the bubble, the most extended and painful the decline. As far away from overpriced assets as you can get, the closer you get to the day they start the business, the further removed you are from the inflated asset problem. You are participating somewhat with the founders if you're early stage enough. I think the interest rate argument is an explanation of how we get there in behavioral terms. It is not by any stretch of the imagination a justification. You don't justify anything by taking the most overpriced asset in the history of man, the bond market, and saying compared to that, we are merely very overpriced and therefore relatively cheaper. That is very cold comfort. Solomon Brothers, an important firm at the time in 1989, sent around a hit squad justifying the Japanese stock market, which was approaching 65 times earnings, we were told at the time. The data was represented as 65 times earnings. That had never previously sold over 25. So that was, to say the least, the real McCoy. And this team went around pointing out that the rates in Japan were so low that 100 PE would be fair. Of course, the collapse that followed in land and bonds and stocks was cosmic. And there,
in 1989, and it still hasn't recovered.
It still hasn't reached the 1989 level in either their real estate market or their stock market, which reminds us of the cardinal rule, and that is the bigger the bubble, the most ingenious the arguments. And the bigger the bubble, the most extended and painful the decline.
You know, what is the alternative? Is there no alternatives to stocks for long-term investors?
That argument is pretty easy to get one's brain around. This is the most broad, as I said, asset bubble of all time, with 3.5 of the 4 major asset classes clearly in severe bubble territory.
Right.
And thinking that you have no alternative but pick between one of the 4 bubbles is a pretty grim way to view life. I get the argument, so pick a bubble, they'll all go together probably, and you will suffer a lot of pain. And the intellectual content of that argument, that they were all bubbles, so we had to pick the least bad one, will resonate in your head as the market unravels.
Is there any way that these bubbles can kind of, you know, just can self-correct, and so that it's not some sort of an Armageddon scenario? Or what is your scenario?
If you had a dozen to 15 years of flat market with earnings doing okay and rotation within the market, everything would work out fine. And every portfolio manager I almost ever met has felt in market bubbles that could happen. It just never does. The market abhors long sideways movements, as we all know. It either goes up more than you think or down more than you think. You can always hold out hope for an extended sideways movement, but it never seems to arrive. Let me just say, by the way, I have enormous sympathy for participating in a bubble. When I was young in 1968, 69, we had a spectacular mini bubble in tiny stocks, and they all quadrupled and made us rich, and then they all blew up together, and most of them went out of business. And I was just out of business school, and I made a small fortune, almost enough to think about retiring to England. And then in the space of about 9 months, I lost everything back to $2,000 and was lucky to cover my leverage and get out without a huge debt. It was thoroughly exciting, probably the most exciting time I've ever had in investing. So I completely sympathize. Nobody who is young and investing and making money is going to listen to some old codger tell his war stories about when he got wiped out. I get that. So there's nothing that I can say that will cause anyone to change their behavior. the power, the psychological power of a bubble to suck everybody in is prodigious. And we've known that since the tulip bubble. And it will never stop.
The market bottom in March of 2009, basically to the day. And you wrote a piece entitled Reinvesting When Terrified, telling clients to get back in the market at that point. At this juncture, it seems like we are in exactly the opposite situation. Should you be, writing a piece de-investing or disinvesting when terrified, and what do you recommend for individual investors who maybe aren't that young and would suffer terrible consequences long term from the bursting of these bubbles?
You suggest to me an interesting title, Disinvesting When Euphoric.
That's a better title than I came up
right.
with. Yes, disinvesting when euphoric.
It feels as psychologically difficult as reinvesting when terrified. They both catch the spirit of the exercise. Well,
right.
I would look around and ask the question, what is the least bad? And the least bad is emerging markets. It's a little overpriced, absolutely, but it is at one of its 3 points of maximum difference to the S&P 500. And each of the other two examples worked out wonderfully well in favor of emerging markets. Conversely, when emerging markets was at a peak, which it was in 07, it sold at a premium PE to the S&P. You can have very bad things happen, which they did. But emerging markets is relatively very cheap and pretty much close to fair value. And the other thing is value versus growth. Low growth stocks have been pummeled by high growth stocks for the decade ending in 2019. And then in the year 2020, they had the worst year by far ever. So you had the worst decade followed by the worst year, and the ratio of value or low growth to high growth was also at the co-equal highest, widest it had ever been with 1974. And the outcome after 1974 for value was wonderful. So I would look at the intersection of those two ideas. If you could buy the value stocks in the emerging market universe, which after all includes...
Which you can, right?
Which you can, and it includes some very high growth potential countries like China, and collectively they will have a higher growth rate than the developed world, almost certainly, and they sell at a huge discount. I would say they are modestly cheap in an S&P world that is extremely overpriced. And you could lock them away for 10 years or 20 years and really expect a decent return, which I would recommend. And since there is no hope of persuading people to actually get out of stocks, that would be the best I could offer. But for those 3 people out there who have a will of steel, I would say also have a cash reserve of 20 or 30%, as much as you can psychologically bear, to take advantage of much cheaper prices sometime in the not too distant future.
So would that be your one investment for a long-term diversified portfolio at this particular point, is to have a stash of cash?
No, I would have low growth emerging markets as much as I could stand.
All right.
And a cash reserve as much as I could stand. And if you had 70-30, 30 cash and 70% cheap emerging markets, that would be a pretty resilient portfolio, I have no doubt. For the next 10 or 20 years, though, I think the S&P, of course, will underperform, just as it had a tough time from 2000 to 2010, where it had a negative return. And emerging markets, incidentally, beat it by 11 or 12% a year compounded.
And Jeremy, is this what you're doing with your personal portfolio?
I don't really have a personal portfolio, but I have a foundation portfolio.
Right.
Job description is make as much money as we possibly can, because we can use every dollar we can make.
All right.
And in the foundation, we have 75% early stage venture capital, which is, of course, unheard of.
Right.
And 25% going on 30 these days in liquid reserves, which you have to have when you have a venture capital portfolio because of the calls on your money that you have committed to.
And
that, of course, has done brilliantly this year. It's
Yeah.
about as far away from overpriced assets as you can get. The closer you get to the day they start the business, the further removed you are from the inflated asset problem. You are participating somewhat with the founders if you're early stage enough.